Silicon Valley Bank was the home of tech startups, the 16th largest lender in America, and held around $200 billion in assets. It collapsed on March 10th, the biggest lender to do so since the global financial crisis. Many of its deposits were larger than the $250,000 that is covered by federal insurance. Regulators stepped in to mitigate the damage.
Every American should feel confident that their deposits will be there if and when they need them.
In 2010, the world was hardly waking up from a financial disaster that struck it and turned it upside down. Only 2 years before, the global economic crisis in 2008, wherein banks were falling like dominoes. Just 2 years was enough to wipe out more than 300 American banks from the face of the earth, impoverishing tens of millions of Americans. In addition to the terrible impact of the crisis all over the world. At this time, former U.S. President Barack Obama was still new to the White House. It had been 2 years for his administration. Just like the global crisis, while economic and labor demonstrations were spreading all over all U.S. states. What could Obama have done in that circus he found himself going through? Do you see the picture in front of you? This is a picture taken on Wednesday, July 21, 2010. It is of Obama signing an act of crucial significance, called the Dodd-Frank Act. He was surrounded by a group of officials, some of whom can be recognized, such as the Speaker of the House at the time, Nancy Pelosi, and the Majority Leader in the Senate at the time, Harry Reid. Despite the presence of all those prominent figures in the picture, these two in particular were the protagonists of the event for enacting that law that is named after them. Chris Dodd, chairman of the Senate Banking Committee at the time, and Barney Frank, chairman of the Committee on Financial Services in the House of Representatives. Remember Barney's face in particular? We would come back to him later. The Dodd-Frank Act imposed comprehensive reforms that created strict oversight of the U.S. financial system, targeted to protect the economy and consumers and prevent a recurrence of the global financial crisis. What does that mean? That is, it imposed unprecedented financial regulations on the financial industry, such as prohibiting certain types of risky practices, setting highly strict requirements to ensure that banks will be able to handle unexpected losses, and to withstand huge bank runs by depositors. It has regular checks and controls to ensure that banks bear the worst economic scenarios. In short, placing strict restrictions on banks to prevent them from manipulating the markets. Well, it is a good firm act. Where is the problem? The problem is that this enactment did not appeal to the tycoons of Wall Street. The presidents and CEOs of American banks opposed it, as it limited their practices and imposed several constraints over them. That is why, as soon as the Dodd-Frank law entered into force in 2010, a great war was waged. Wall Street executives heavily criticized the law along with the Obama administration. They used legions of lawyers, corporations, and lobbyists, spending tens of millions of dollars to roll it back. But they failed. Why? Because Obama and his administration adhered to the law. For it was the only guarantee that the financial nightmare would not take place again. For that, when failed to put an end to the law, these lobbies tried other different approaches to mitigate its hindrance and constraints. They kept quarreling, spending millions of dollars over the course of 8 years. They were finally able to make it in 2018. The result of their success was the new financial disaster that manifested 5 years later, specifically during the first half of the current month of March, wherein the first domino fell, the SVB Bank. What happened in 2018? What does it have to do with the collapse of American banks? Who is in charge of that? What headway circumstances led to this impasse? And what is the story of Barney Frank? These are some of the crucial questions we would be answering in today's episode. Before we start, I would like you to subscribe to the channel, so do not forget to share them with your friends and get them to know the channel. I am Tim Scott and this is the ECOINFO Plus. After the adoption of the Dodd-Frank Act in 2010, all American banks that have assets of more than $50 billion, even the giants of Wall Street, were totally under control. Everyone was taking the bull by the horns. There were no securities violations, no risky financial products. There were periodic stress tests for all banks to assess their ability to face liquidity problems and others. Well, who was quarreling to get away with more stringent regulations? Small and medium banks. Legions of CEOs of these so-called regional lenders or regional banks were pressing their case to the U.S. Congress in every possible way to tone down the Dodd-Frank Act. They spent millions of dollars on lobbyists to secure votes to help them weaken banking regulations. As we said, guess what are the most notable banks that pressured Congress to weaken the regulations at the time? Exactly, the executive directors of the banks that collapsed during the past few days, along with the executive directors of other banks that have signs of a crisis of confidence now, and they might be falling in the short term. At the head of the executives is Greg Baker, CEO of Silicon Valley Bank or SVB, who was running the bank just hours before its collapse on March 10. In the year 2015, Greg Baker delivered in person a statement to a Senate panel, pushing them to ease the constraints of the Dodd-Frank Act on medium and small banks similar to his own. Well, what was that man's and other CEOs. Problem with the Dodd-Frank Act? Baker stated to the senators that the regulations imposed by the Dodd-Frank Act burdens mid-sized banks, and that it reduces for no good reason their ability to provide the banking services that customers need. He had argued that the compliance costs and human resources he is having to save because of the Dodd-Frank regulatory measures imposed will force SVB to divert its resources to it, rather than focus on providing loans to the small and growing businesses that are the engines of job creation in the U.S. economy. He was focused on the idea that the SVB Bank, unlike the giants of Wall Street, that regulators are supposed to focus on specifically according to the Dodd-Frank law, is just a small financial institution. Therefore, legislators should pass legislation that allows the SVB to avoid thousands of hours annually that banks spend on stress tests and preparing settlement plans. He also emphasized the ability of SVB Bank to manage strong risks and that they have a strong understanding of the market in which they operate. In short, his real message to the legislature was, get the small and medium banks out of this. They are no real threat, just focus on tycoons. During this period, SVB spent $500,000 on lobbyists. As we said, it was not the only bank that was quarreling to roll back the safeguards of the 2010 Dodd-Frank Reform Act. Do you remember Barney Frank? We previously mentioned at the beginning of the episode, saying we will come back to him. Barney is the principal architect of the Wall Street Reform and Consumer Protection Act, which is named after him and Chris Dodd, as we said in the introduction. That is, he is considered the godfather of the law from which medium and small banks are suffocating and strangling. The shifting point is that Mr. Barney retired in 2013. 3 years after the law was approved, which he himself enacted. After retiring, and just out of the blue, he repeatedly voiced support to reduce safety standards and deregulate the law. Can you imagine what happened? Okay, the worst is yet to come. In 2015, Barney Frank joined the board of directors of Signature Bank. Thus, he turned completely to the team pushing to roll back the procedures for medium and small banks, after he was one of the two who enacted the law that regulates the American banking sector and prevents another global crisis with its procedures. Barney remained on the board of directors of Signature Bank from 2015 until March 12, after the regulators seized the bank and dissolved the board of directors. The New York Times reports that Barney Frank took $2.4 million in cash and shares during the 7 years he spent on the board of directors of this bank. Among the CEOs, who were also quarreling to roll back the Dodd-Frank Act, is Harris Simmons, CEO of Zions Bank Corporation. He considered that the legislations of the Dodd-Frank Act were burdensome federal oversight on them, and that regional banks such as his did not pose a significant threat to stability. Financial and strict regulations hinder their ability to serve customers. In 2017, Simmons wrote in the American Banker magazine that if the regulations on regional banks were eased, additional capital would be available for those banks, amounting to $4 billion annually, and they would be available for lending. To support his opinion, he quoted that, Mr. Barney Frank, who enacted the law himself, is the one who calls for rolling back now. Going back a little bit earlier to that, specifically in November 2016, Trump surprised the world when he won the U.S. elections and made it to the White House. Of course, I do not need to tell you that Trump was one of the biggest advocates of easing the restrictions imposed by the Dodd-Frank Act. It was part of his promises in his election campaign. That is why, after 1 week of taking office, only 1 week, he described the Dodd-Frank Act as a disaster and promised to change it. And he did it, in May 2018. That is, after 10 years of the global financial crisis, Congress approved the deregulation of the law, freeing thousands of small and medium-sized banks from the strict rules imposed by the Dodd-Frank Act in 2010. Trump signed the new bank deregulation bill and said at the time, "It's really a great day for America. Let's see what this great law did for America and what are its results." The Dodd-Frank Act said that any bank with assets less than $50 billion would not be subject to the strict rules governing the banking sector. Trump's law raised this limit to $250 billion. That is, any bank with assets of $250 billion or less will escape the strict regulation. This is exactly what small and medium banks wanted, as after the minimum assets owned by banks were raised, thousands of banks got out of Dodd-Frank's grasp. Can you imagine how many banks would have been subjected to the strict Dodd-Frank regulation after this amendment? Less than 10 big U.S. banks, and the rest were free without tight oversight. Pay attention, what we are about to say is of crucial significance. The meaning of the aforementioned is that thousands of medium and small U.S. banks such as SVB, Signature Bank, and others are no longer required to do the following: maintain certain levels of liquidity, and thus have the ability to withstand losses, compliance with the stress test, whether that is done by the bank itself to test its banking strength, or that which is done by the U.S. Federal Reserve, provide periodic and up-to-date plans to close the bank in times of a crisis, All of these procedures were a must-do by banks, thus they helped to reveal the defects and problems of any bank too early, in accordance with the Dodd-Frank law. Yet, in May 2018, all of this ended with Trump. For example, with regard to capital and liquidity requirements, this procedure was required of banks, including medium banks like SVB, to keep a sufficient balance of cash available so that they can withstand the storm. What actually happened? Beginning in 2020, SVB began receiving deposits in huge quantities and at a rapid pace, and the volume of deposits ranged from $49 billion in 2018 to $102 billion in 2020. The year after that, there was a bigger jump in the volume of deposits, and it reached in 2021 to $189.2 billion. In this case, wherein the bank has huge deposits and does not know how to lend them or what should it do, SVB management did the worst thing possible. It poured most of the balance into higher-yielding assets, which were long-term fixed-income bonds. The bank at that moment was like a mouse running after a piece of cheese, careless for anything else. The piece of cheese here was the rise in profits to a record level of 52% in 2021, and thus this helped raise the bank's valuation by more than $40 billion. But in fact, the bank was getting into the trap. Here, the bank made a fatal error. First, it did not keep a certain available balance in order to be able to withstand any sudden bank runs. This is due to evading the law that enacted such conditions. As a result of that, by the end of last year, the bank had only $15 billion in cash. Someone might be asking, can the bank sell the bonds if it needs cash, or what? Here comes the second fatal error committed by the bank, that it concentrated most of the deposits that it generated in long-term bonds with a fixed return, and therefore it was not able to hedge against the rise in interest rates. According to documents seen by Bloomberg, the bank's Asset and Liability Committee in late 2020 received an internal recommendation that it should buy short-term bonds in order to reduce the risk of exposure to large losses if interest rates rose suddenly. That's great. What happened to this recommendation? They totally ignored it. The bank executives kept plowing cash into long-term bonds in order to maximize profits. Of course, this bond option was imprudent when the bank suddenly needed cash. Ironically, the bank has been running for 8 months without anyone in office for a significant and important position. That is the Chief Risk Officer, known as CRO. Starting from April 2022 until January 2023, the bank did not have anyone in place of Laura Izerda, who resigned from her position as CRO, and this was a crucial period in which the bank faced many challenges and risks. Chief Risk Officer is the one who anticipates and manages all kinds of risks facing the company or the bank. In our case here, whether these risks are organizational, operational, or competitive, and reports directly to the board of directors and CEO. By the way, before the Trump Deregulation Law Act of 2018, a CRO in office was a must. No bank could run for even 1 month, not 8, without a CRO. But of course, after Trump's law, banks were no longer obligated to employ anyone for the office. Okay, how did the SVB manage his risks in these 8 months? Only God knows. After the U.S. Federal Reserve started raising interest rates from March 2022 from almost 0 to nearly 5% now, SVB Bank was deeply in trouble as it lost more than $16 billion in unrealized losses on its holdings of the long-term bonds that it sought to. Here appears the importance of the stress tests that were lifted off banks after the deregulation law of Trump and the Wall Street lobbyists. Stress testing in a very brief way is a computer simulation method through which we predict how the bank will behave in various bad situations, such as the rise in interest rates, which here caused the collapse of the SVB Bank. It is the secret behind all what happened. Interest rate risk in the banking book, known as IRRBB, through which one knows the current or expected risks to the bank's capital and profits due to fluctuations in interest rate. There is also managing interest rate risk, through which I can reduce interest rate risk by purchasing bonds with different maturities or by hedging fixed income investments through interest rate swaps, options, or other interest rate derivatives. All of these are tests and tools that banks must do on a regular basis. But all of this did not happen in SVB Bank because Trump disrupted all this for banks, whose assets are less than $250 billion, as we explained. Of course, if the bank had been subject to stricter rules, and if the regulators had given it a stress test, its weaknesses and problems would have been easily revealed, and it would not have been allowed to buy long-term treasury bonds. His portfolio of investments could not have swelled to 57% of its total assets, which is a very dangerous percentage that no American bank has reached. The highest rate was 42% among 74 other competing U.S. banks. Thus, we would not have seen SVB Bank, which became the bank number 16 among the largest American banks, collapsing to become the second largest bank collapse in American history and the first collapse after the global financial crisis in 2008. we would not have witnessed the collapse of Signature Bank 48 hours later, making it the third largest bank collapse in U.S. history, nor the collapse of Silvergate Bank. By the way, those banks will not be the last in this crisis. Do you remember Harris Simmons, CEO of Zions Bank Corporation, who was also calling to get Dodd-Frank toned down? At the time of filming the episode, Moody's agency was preparing to reduce the credit rating of this bank, and 5 other regional banks, Comerica Bank, First Republic Bank, Western Alliance Bancorp, Intrust Financial Bank, and UMB Financial Bank. Will these banks survive after the official reduction of their credit ratings? Hours before filming the episode, a rescue operation took place for a new victim, never heard of it, which is First Republic Bank. But this time the rescue came from Wall Street giants in an attempt to stop the escalating crisis by supporting troubled banks. Bank of America, Goldman Sachs, and JP Morgan have agreed to deposit $30 billion in the troubled bank, which is suddenly suffering from customer withdrawals of deposits after the collapse of SVB. The financial collapse that happened to some American banks sent shockwaves around the world. Despite the intervention of the U.S. government represented by the U.S. Federal Reserve and the U.S. Treasury Department in an exceptional procedure and their announcement to guarantee all customer deposits in the banks that collapsed, yet the problem of the bank remains unsolved until the time of filming this episode. I am finished now, and I have a question for you. Do you think this crisis will pass as a storm in a teacup, or will it expand outside the United States, as seen recently in Switzerland? Will it become a new global crisis? I will keep up with your answers in the comments. Do not forget to subscribe to the channel as said. If you liked the episode, please hit the like button and share the video. And the most important thing is to tell your friends and loved ones about us. They may like it as well, and please get them to know the channel. Goodbye.